Something extraordinary is happening in the gold market right now. Something that most investors won't see coming until it's too late. And when I say too late, I mean the kind of too late where you're watching prices on your screen wondering how you missed the biggest wealth transfer in modern history. Let me paint you a picture of what's unfolding. For decades, the gold market has operated on a simple premise. Paper contracts determine the price. You've got the COMEX in New York, the LBMA in London, and these massive exchanges where billions of dollars in gold trades hands every single day. Except here's the thing, most of that gold doesn't actually exist. It's paper, promises, digital entries in a ledger, and that system is starting to crack. Right now, delivery requests at COMEX have exploded. We're talking about a surge that would make your head spin. In just half a month recently, delivery notices hit levels that exceeded entire previous years. Think about that for a second. People aren't just trading paper anymore. They're demanding the actual metal. They're saying, I don't want your promise, I want the gold. This is where it gets interesting. The paper gold market operates on something called fractional reserve. Just like banks don't keep all your deposits in the vault, the gold exchanges don't have all the physical metal to back every contract. They're counting on most people just trading paper back and forth, settling in cash, never actually asking for delivery. But what happens when everyone shows up at the bank at the same time? Central banks figured this out years ago. While retail investors were buying ETFs and paper contracts, central banks were quietly accumulating physical gold at a pace we haven't seen in half a century. They weren't buying paper. They were loading up on bars, moving them into vaults, taking possession. They understood something that most investors are only now beginning to grasp. The paper price and the physical price are about to diverge. Let me explain how this works. Right now, when you see gold quoted at whatever price on your screen, that's the paper price. That's what it costs to buy a futures contract or an ETF share. But try to buy 1,000 ounces of physical gold for immediate delivery. Call up a dealer. See what premium you have to pay above that spot price. That premium has been widening. In some markets, it's already significant. This is the early warning signal. Think back to 1971. Nixon closed the gold window because foreign governments were doing exactly this, demanding physical gold for their paper dollars. The United States didn't have enough gold to meet those demands, so they changed the rules. They broke the promise. And gold went from $35 an ounce to over $800 within a decade. We're watching a similar dynamic play out, but this time it's not just governments. It's institutions, family offices, sovereign wealth funds, and increasingly, individual investors who are waking up to the reality that paper promises might not be worth the paper they're printed on. The mechanics of this are fascinating. The COMEX operates on a system where for every 100 ounces of paper gold traded, there might only be 1 or 2 ounces of physical gold actually available for delivery. This works fine when it's just speculators trading back and forth, but when the music stops and everyone wants their gold, there's not enough chairs. And we're starting to see signs that the music is slowing down. Look at what's happening with gold refineries. They're running at capacity. Wait times for large bars have extended. Premiums for coins and smaller bars have spiked. These aren't abstract market signals. These are real-world constraints showing up in the physical market, while the paper market continues to operate as if infinite supply exists. Here's where it gets even more interesting. The paper market can suppress prices through naked short selling, through massive contract dumps during thin trading hours, through all sorts of mechanisms that work beautifully when you're just moving digital entries around. But you can't naked short physical gold. You can't dump 1,000 tons of actual metal onto the market at 3 in the morning to push the price down. Physical gold has weight, has location, has real-world constraints. And those constraints are starting to matter. Consider what happened in the nickel market recently. The London Metal Exchange had to halt trading and cancel trades because the paper market got so disconnected from physical reality that the entire system nearly collapsed. Traders who had sold nickel, they didn't have suddenly faced delivery demands they couldn't meet. Prices went parabolic. The exchange had to step in and essentially rewrite the rules to prevent a complete meltdown. Now imagine that scenario, but with gold. A market hundreds of times larger, with central banks involved, with geopolitical implications, with trillions of dollars in derivatives and contracts all built on the assumption that paper and physical are interchangeable. They're not. The smart money has been positioning for this. You can see it in the data if you know where to look. Commercial traders, the big banks, and institutions that actually deal in physical metal have been reducing their short positions. They're not betting against gold anymore. They're getting out of the way. Meanwhile, the managed money, the hedge funds and speculators, are still playing the paper game, not realizing the rules are changing. This creates an asymmetry, an opportunity, but also a risk if you're on the wrong side of it. Let me tell you about something most people don't understand about gold storage. When you buy a gold ETF, you own shares in a fund that supposedly owns gold. But do you have any claim on that physical metal? Can you show up and take delivery? For most ETFs, the answer is no. You own paper that represents gold. And in a crisis, when the paper and physical markets diverge, that distinction becomes everything. This is why we're seeing such a surge in demand for physical gold IRAs and direct ownership. People are starting to ask the right questions. Where is my gold? Can I take possession? Is it allocated or unallocated? These questions didn't matter much when paper and physical tracked each other perfectly. But in a world where they're diverging, these questions become critical. Now, if you're sitting on significant retirement savings, say $100,000 or more in traditional accounts, this is something you need to understand. There are ways to hold physical gold within retirement accounts, actual metal that's allocated to you, stored in your name, that you could theoretically take delivery of if needed. I put together a detailed guide on how this works, how to do it without tax penalties, what to watch out for. It's in the description if that's relevant to your situation. Worth understanding your options before the gap between paper and physical widens further. But let's get back to the bigger picture, because this is about more than just individual positioning. This is about a fundamental restructuring of the global monetary system. For the past 50 years, since Nixon closed the gold window, we've lived in a pure fiat currency world. Money backed by nothing but government promises and military power. And for 50 years, the paper gold market has been one of the key mechanisms for managing the price of gold, for keeping it from reflecting the true debasement of currencies. That system is breaking down. You can see it in the behavior of countries like China and Russia. They're not just buying gold. They're building infrastructure to trade gold, to settle transactions in gold, to create alternatives to the dollar-based system. And they're doing it with physical metal, not paper contracts traded in New York or London. The BRICS nations have been discussing a gold-backed trade currency. Whether that happens exactly as proposed or not, the signal is clear. Major economies are moving away from pure fiat and back toward gold as a monetary anchor. And when they do that, they need physical gold, not paper promises. This creates a supply problem. Annual gold mine production is around 3,000 tons. Central bank buying alone has been running at over 1,000 tons per year. Add in jewelry demand, industrial demand, and investment demand, and you've got a market that's already tight. Now add in the possibility of a rush from paper into physical, and you've got the setup for a supply shock that could make oil in the 70s look tame. The paper market has masked this reality. By allowing unlimited paper gold to be created and traded, it's given the illusion of abundant supply. But that illusion only works as long as people are content to trade paper. The moment they demand physical delivery, the illusion shatters. And we're seeing the early stages of that shattering now. Look at the premiums in different markets around the world. In some Asian markets, physical gold trades at significant premiums to the London spot price. In times of stress, those premiums can spike to 10, 15, even 20% above spot. That's the market telling you that paper and physical aren't the same thing. Now imagine that premium going to 50%, or doubling, or the paper market simply failing to deliver, forcing a reset where physical gold has to be repriced to reflect actual scarcity rather than paper abundance. This isn't speculation. This is pattern recognition. Every fractional reserve system in history has eventually faced a run. Every paper currency has eventually failed. Every promise to deliver physical assets has eventually been tested. And when the test comes, the people holding paper promises learn a hard lesson about the difference between claims and possession. The gold market is no different. It's just taken longer to reach this point because the system is so large, so entrenched, so critical to the functioning of the current monetary order. But size doesn't make something immune to the laws of economics. It just makes the eventual reckoning larger. Think about what this means for price discovery. Right now, the price of gold is set by paper trading in New York and London. But if the physical market detaches, where does price discovery happen? In Shanghai? In Dubai? In private transactions between central banks? And what happens to all those derivatives and contracts that are settled based on the COMEX price, if that price no longer reflects physical reality? These aren't theoretical questions. These are practical problems that the market is going to have to solve, and the solution is likely to involve much higher prices for physical gold and a lot of chaos in the paper markets. The historical precedents are instructive. In 1980, the Hunt brothers tried to corner the silver market. They accumulated massive amounts of physical silver and silver futures. When delivery time came, the exchanges changed the rules, went to liquidation-only trading, and crushed the price. The hunts lost billions. But here's the difference. The hunts were individuals trying to manipulate a market. What's happening now is a systemic shift driven by central banks, sovereign nations, and fundamental supply-demand imbalances. You can't just change the rules and make that go away. The pressure is too large, too distributed, too fundamental. When the paper gold market faces its reckoning, there's no easy fix. You can't just halt trading or cancel contracts without destroying confidence in the entire system. And once confidence is lost, it's nearly impossible to restore. This is why the smart money is moving early. They're not waiting for the crisis to hit. They're positioning now, while physical gold is still available at reasonable premiums, while the system still functions, while there's still time to get out of paper and into metal. The signs are everywhere if you're paying attention. Mint production is running hot. Dealer inventories are tight. Delivery times are extending. Premiums are rising. These are all symptoms of a market where physical demand is outstripping supply while the paper market continues to pretend everything is fine. And then there's the geopolitical dimension. As the world fragments into competing blocks, as trust in institutions erodes, as currency wars intensify, gold becomes more than just an investment. It becomes a strategic asset, a form of money that doesn't depend on any government's promise, a store of value that can't be printed or debased. Countries understand this. That's why central bank gold buying has been so aggressive. They're not buying gold because they think it's going to go up 10 or 20%. They're buying gold because they think the current monetary system is unstable and they need a foundation that doesn't depend on someone else's liability. When central banks are buying physical gold aggressively while the paper market shows relatively modest price increases, that's a divergence that can't persist. Either the paper price has to rise to reflect the physical demand, or the two markets have to separate entirely. We're heading toward one of those outcomes. And based on the trajectory we're on, it's looking more and more like separation is the likely result. What does that mean practically? It means that if you own paper gold, ETFs, futures, unallocated accounts, you need to understand that you might not have what you think you have. In a crisis, those paper claims might settle in cash at a price that doesn't reflect what physical gold is actually trading for. It means that premiums for physical gold could explode, making it difficult or impossible to convert paper profits into actual metal. It means that the price you see quoted on financial websites might become increasingly irrelevant to the price you'd actually pay to acquire physical gold for immediate delivery. These aren't doomsday predictions. These are logical consequences of a fractional reserve system under stress, and the stress is building. The paper gold market has served a purpose. It's provided liquidity, price discovery, and a way for investors to gain exposure to gold without the hassles of storage and security. But it's also created a massive overhang of claims on physical metal that can't possibly all be satisfied simultaneously. And we're approaching the moment when that reality becomes undeniable. The question isn't whether the paper and physical markets will detach. The question is when and how severe the dislocation will be. Based on current trends, the surge in delivery requests, the aggressive central bank buying, the tightening physical market, the geopolitical tensions, it's looking like sooner rather than later. This is one of those rare moments in markets where you can see a major shift coming before it fully materializes, where the early signs are visible to anyone paying attention, where positioning ahead of the crowd could make the difference between participating in a historic wealth transfer and watching it happen from the sidelines. The paper gold market is a construct, a useful fiction that's worked for decades. But all constructs eventually face reality. And the reality is that gold is a physical metal with real-world constraints, and no amount of paper creation can change that fundamental fact. When the detachment comes, when paper and physical finally separate, the repricing is going to be swift and dramatic. The people holding physical gold will be fine. The people holding paper promises are going to learn an expensive lesson about the difference between claims and possession. The smart money is already moving. The question is whether you'll move with them or wait until the crowd figures it out. Because by the time everyone understands what's happening, the opportunity to position at reasonable prices will be gone. This is the setup. This is the moment. The price of gold is about to detach from paper. And when it does, the world is going to look very different for those who prepared and those who didn't.